Hey, welcome to A Trader's Life. As everyone knows, to excel in trading, you have to exercise great discipline. My next guest has this quality in spades. Not only was he in the army for a few years before he started trading, he was also an engineer. Paul Bratby has become so successful as a trader, he now lives in tax exile in Dubai, runs his own fund, plays golf when most people are in front of screens working themselves to death, and he's also set up his own education business and a software to enhance the strategies that have made him a success. Paul is also very good on confluence and has written a book on the subject. Anyway, I'm not a great fan of CVs and resumes. Let's get to the story. Here's Paul. Hey, Paul, how are you doing?
Very well, thank you. How are you doing?
Yeah, good. How was the golf? You held me up.
It was, yeah, I do apologise. I was playing with three South African guys and they like to talk.
Okay.
Yeah, it's crazy who you meet over here in Dubai. I mean, two of them were pilots for the royal flight. They fly the royal family around the world. So it's just, they had a lot to say.
Yeah, no worries. Well, we're going to get to how you ended up in Dubai toward the end, but what about the beginning? How did you get into trading? It was quite circuitous, I seem to remember.
Yeah, back in the day when you had dial-up internet and 386 SX tower computer, that's when trading first became sort of almost mainstream. You had forex brokers like FinTech, some of the older real brokers, and they were online. So that's when, and I was still in the army at the time, just trying to find something else to, extra income and things like that. So it wasn't easy because dial-up internet, if it goes down and you're in a position that in those days you could be 10 minutes before you back up and you've totally blown your account. So it wasn't easy in those days. One of the reasons why I pretty much moved to swing trading in those early days was purely because I didn't want the risk of losing the internet and then coming back on to find myself lost all my money.
Yeah, absolutely. So, how did you develop from there? Because you left the army, didn't you, at some
Yeah,
point?
so during the army, actually, I was attending a hydraulics engineering course because I'm an engineering manager in the army, and things just clicked to me while I was on this course, all about flows and inputs, and again, this is where the confluence has come that came in the early days because there's a lot of confluences within a hydraulic circuit, and when certain things happen, you get something the other end, and all of a sudden that just really twigged for me exactly that's what markets are. I just need to see where those buttons are pushed to so it moves in a certain direction and I can understand that directional flow. So I got good at it. I got good at trading, and I left the army at the age 32 because the income was sort of bigger than my army salary. So why wouldn't you? So that's and that gave me the freedom then to continue to trade. And obviously, technology came on in leaps and bounds through that 20 years. Is from what we had then to what we have now is just phenomenal.
Yeah. What were you trading back then?
So mainly to begin with forex, and then when I switched to swing trading, I tried swing trading euro US dollar, but it was just too volatile. So I turned to US stocks, big US stocks. You can swing them for anything from, I don't know, 20 days to sometimes 60, 90 days, good moves. And that's where that's where I sort of cut my teeth really, because forex is very dangerous. Most people start because it's cheap. You can put $500 in the account, and if you lose it, it doesn't matter. And that's the sort of attitude that a lot of 95 million retail traders have. But I wanted to learn properly. Forex market is a little bit biased towards the brokers anyway, and I learned that the hard way a few times. So I started to move to stocks, and then I went to US brokers for futures as well later on.
Okay, and today what do you trade?
So I trade US stocks and I trade futures. Mainly, I trade copper and oil futures. That's the day to day. I was trading live yesterday in front of our community, and oil wasn't moving, but copper had some great moves. So I just focus on those two. Most people, I always advise people just to get one instrument. It's like being married. Understand the behavior of that one wife. Get married to oil, get married to copper, and just trade that. Don't swap and change. If you're a Forex trader, understand that one Forex pair, how it reacts to economic data on a Thursday, on a Friday, for example, we had German data that came out yesterday, the inflation rate, how that affects the US dollar, and then how that affects oil. And so, I basically day to day trade futures and longer term positions and swings on stocks.
Okay, and why did you gravitate toward oil and copper rather than, I don't know, gold or silver or any of those others?
So gold can be pretty range bound and flat. You need volatility. You need up and down volatility. You can't. When gold goes flat, for example, when U.S. markets are doing well, you got tech stocks blowing through the roof and everything like that. Nobody goes to gold. Gold goes quite flat. You need a commodity to trade that is used a lot and not just a safe haven when stock markets go down. So oil and copper. Just lately, and I mention it in my book, soybean futures is phenomenal. It's a great contract to trade. All these vegan foods, plant-based foods, and even my wife eats edamame every other day. Soybeans is a very sought after commodity, and it's very, very tradable. So you've got to find an instrument that is tradable. Everybody sort of gravitates towards gold, but there's not great moves in there. Copper moves brilliantly, because copper's used a lot. And when there's a shortage, the price goes up. And it's as simple as that. There's no real use for gold in real terms. A lot of it is just hoarded. But oil's used, copper's used, soybeans. So you need to find something that's used regularly that will have that volatility trade.
And how do you look at oil? Will you be very mindful of the fundamentals given the geopolitical connection, or will you be very much chart based trading, you know, yeah, analysis, really technical analysis?
So there's two things. I always look for major geopolitical events that could affect, and that's where the confluences start. Imagine trading oil as at the top of a mountain where rivers start to form. You need to understand the tributaries that are going to increase that directional flow, whether it's up or down, and that starts right at those fundamentals and those demands, things like that. You're talking big geopolitical events don't happen all the time, but when they do, you need to understand what's going to happen. But also, you've got to look at things like CPI data. If there's a massive miss in the US and the US dollar really reacts, oil will react. It is, there's lots of confluences in there that you need to understand the flow. And this is why I say get married to one instrument, because there's lots that can affect that instrument and you need to understand the behavior. And then obviously technical is where you need to understand that's going off. So I always say, for me, for oil and copper, the beginning of the year, I reset my operational landscape for each chart. So I start on the daily, the weekly, work down from 60, then to 30. And then I trade off the 10, 3 minute, and sometimes Unirenko. So I've set all of those multi-time frame support and resistance zones up. So I have my operational landscape. Is there any major sort of trend channels that have been broken? Identify those on those time frames as well. So you've got that operational landscape to trade, and I always trade between the support and resistance zones. I look for fresh air. There's different types of strategies that I'll use to do that, but in reality, if I get a signal, I need the confirmation but then I need fresh air to trade into. So that operational landscape is extremely important for me. And then I will see what is, what potentially is going to happen. So yesterday, for example, it was only good trading pre-market US purely because we had the Fed interest rate in the afternoon, and it always gets a little bit choppy and there's no real directional move. But we understand that the German data at 8 a.m. EST before the gold pit open will or should affect the US dollar, which then will affect the commodities. Oil went flat yesterday, but copper had some great reactions. So it's understanding what's happening day to day, week to week, what will affect, what confluences will affect. I mean, sometimes you've got a good directional flow and you've got a big bit of data comes out, and it's almost like a dam's been built and the directional flow slows down or even changes direction. And that's very important now. So just looking at a chart isn't going to give you um, uh, a good chance to get a high probability win rate.
And for copper, what are you looking there? Yeah, I guess the dollar, it always starts with the dollar,
So
doesn't it?
US dollar, but also we look at the there's some very similarities with oil. So we get correlations with oil at certain times of the day. So the London Open, from London Open to US Open, we get some good positive correlations with oil and copper. And then pre-market to the US, they usually go negative correlation. That's normal behavior. But then I always look at the gold pit open in the US for another catalyst for copper to run. So yesterday we had the gold pit open at 8:20 a.m. EST. I look what happens in the first 10 minutes till 8:30, and I then find the bias. And yesterday was a great breakout to the upside on copper. Because more gold traders come in, there's more activity, and that has an effect on that copper market as well.
Oh, interesting. And so you developed your own strategy mainly through technical analysis in the early days, and you were swing trading, and then you moved on to these two commodities. You also run your own software company, and you've developed more than one indicator by the sounds of it.
Yeah.
Talk to me about the process, how you got around to doing that, and who you got to help make you.
Okay,
Yeah.
so 10 years ago now, I retired because I got fortunate, I got lucky, if you like, that I was good at trading. People recognized that. And then all of a sudden, I became a money manager and I was managing $80 million. I was averaging 65% a year. And there's a lot of pressure with that. I'd made a decent amount of money and I retired at 45. But when you're 45 and playing golf with somebody that's 75, there's not a lot in common, and you get bored. So what I wanted to do is I wanted a hobby, and this is how it all started as a hobby, is to try and take complexity out of trading. So back in the day, if you wanted to understand Elliott wave theory, for example, you would have to do a hell of a lot of learning. You'd need to understand fib extensions, retracements, overlaps. You'd need to understand how to, identify those impulse waves and the pullbacks and the rules and all that sort of thing. There's lots to learn, lots of things, and the charts get messy. So I went to a few guys in America and I said, look, I want an algorithm to do all of this so people can just make decisions when they get a signal to get the confirmation and trade into fresh air. So that was the first indicator suite that we actually developed, and that was for Think or Swim's TD Ameritrade Think or Swim in the US. And we were the first Elliott Wave indicator suite. That's now on 7 different platforms, whether it's TradingView, TradeStation, NinjaTrader, and that was the first one because that's probably the most complex strategy out there. If you can take away all of those measurements and actually allow visually for the trader to look at that wave 4 pullback and look and understand the behavior and just trade that fifth wave because that's the highest probability move. So there was other strategies then that I obviously used manually over the years and developed. So when something's not trending, for example, traditional strategy would be a stochastic MACD cross, but they're notoriously difficult to trade. So I wanted to make that simple. So I wanted 3 points of control. So it's not just a MACD and stochastic cross. I wanted 3 points of control to confirm a short or a long entry, because once you get something range bound, it is like a roller coaster. It goes up and down within the range, from overbought to oversold and overbought to oversold. But there is something that I was using manually to confirm those trades when a market was in that position. So we came up with the roller coaster indicator, which basically measures those stochastic MACD cross, give those 3 points of control, and puts a signal long or short. It even prints the trailing stop. So actually, on the chart, it looks like a roller coaster, and that's been my whole philosophy over the last 10 years: is to simplify what is complex trading strategies. The latest one, which is only available on NinjaTrader, is the slingshot. That measures pullbacks. And that's why it's called the slingshot. You get an impulse move, it pulls back, it measures the probability of those moves and gives you three targets for when it slingshots in the same direction. But again, quite complex to trade, and the same with harmonics. Most people, when you say harmonics, can read a book for 6 months, do a course, and still not understand how to measure the ABCD and predict where that D pivot is going to end. And if it, and our software does that. So, software's there to help, not to make things more complicated. And that's been, my journey over the last 10 years, really. So it's gone from hobby to serious business. And now, obviously, the books come out as well. So it's not retirement.
Yeah. And yes, talking of your book, Confluence, Not Coincidence. When did that start? When did you start writing?
So it's been on my mind for the last 5 years, but there's always a reason when you've never written a book before not to write it. So something comes up, or I've got a new bit of software I need to test, and been working on the logic for something for a year, and the developers just landed the new software, new toy on my desk, and I want to play with it. But the good thing about being in Dubai is you can be really busy, but it's so hot in the summer. We have a place in south Spain, and we went there for 2 months last summer. And my idea was not to work, not to trade, to just write the book. And it took me 6 weeks to write the book. Then it took 6 months with the publisher, editing team, and all that sort of stuff to actually get it to be published. And now it's in Barnes and Noble in the US. It's on Amazon all over the world. It's fantastic. I mean, the writing was the easy bit. I've got 3 more books up here, but the editing process is quite lengthy and stressful, because you still want the same message that's in your head going to people. So I think there's a lot. It's a new thing for me, and I enjoyed the process, because I've got a lot of knowledge and experience, and it's trying to share it without being too complicated. What I've tried to do is lift the lid off those tributaries, if you like, that those confluences, that so people can identify the strength of the directional flow, and that's whether it's geopolitical, economic data. I mean, I even have a section on the book where I talk about hurricane stocks. When there's a hurricane in Florida, Home Depot, Lowe's, and everything else, once the insurance companies pay out, their profits soar for a quarter, but also then the insurance companies go down because they're paying out. But then guess what? They put their premiums up, and then insurance companies make new highs in the next 2 quarters. This is a constant flow as long as there's hurricanes. So it's understanding those confluences, and being open to them, rather than just sticking yourself in front of a chart and trying to second guess why this is moving and what's happening. The book tries to simplify and open up the idea of technology, allowing you to do the heavy work and allowing you to spot those confluences.
Okay, cool. Are you mainly looking, besides sort of confluence with respect to fundamentals, are you looking to talk about some of the other strategies you've developed into the software, that kind of thing? Right.
In the book, yes. So what I do is it's so yes, there's fundamentals. You've got to understand as well that when you're putting the operational landscape on your charts, you've got linear and non-linear support and resistance zones. You'll usually find if the those are the reasons when, for example, the S&P 500 reach a confluence of sort of 60-minute daily and weekly sort of resistance, uh, and then there's some weak data that comes out. The weak data is the catalyst for institutionals to traders to say, actually, there's not enough fuzzy feeling to go long here and to continue to go long an S&P. I'm actually going to go short here. We've had this bad data. We're at big resistance. We're gonna start to sell, and that could be Apple at the same point as well. When the chip sector had issues with demand and everything like that, some stocks really struggled, and there was no coincidence there. They were all the ones that did sell off quite quickly were all at major resistance zones. The ones that didn't sell off so quickly weren't. And that's the same with the pandemic pullback, whether it's Russia invading Ukraine. And then I go into actually putting strategies together, and I call it a confluence trading strategy. So, for example, if you're trading bonds, and you're using one specific strategy, the trading opportunities are small. You may only get one, two trades a month on bonds. But if you combine strategies that look at different market conditions together, there are more trading opportunities and more confluence with those. So, for example, we have a thing called the VWAP Predator. So it looks at the VWAP, but it looks at volume as well. So when we cross the VWAP with higher than average volume, with a certain size candle that it can't be too big, and it has more, and it's an accumulation candle if it's going up, or it crosses one of the fib extensions to that, that move up is all volume. It's that strategy is volume. But then if you get also an XBRAD algo, which is 12 points of control, 12 different technical indicators, and all 12 are saying go long as well. And you've got a VWAP Predator long, the stars are aligning, the confluences technically are aligning with different strategies. And I talk about those in the book as well, because I think it's very important for people not to rely on one specific strategy. I never trade harmonics, but I have them on my charts because if a harmonic back pattern, for example, finds support in the what we call a target zone, if it finds the D pivot finds support in that and completes in that completion zone, and then it starts to move away long from that target zone, and I'm getting signals from the XBRAD algo, the VWAP Predator, or the slingshot. All of a sudden, that was my main support catalyst. If there was a confluence with support on linear support and resistance zones, then all of a sudden it starts to move away. I get another technical indication from a different type of strategy. That's when I'm starting to understand that directional flow is getting stronger to the upside. So I'll never trade harmonics on their own, but I will use them when they happen and they complete. They're very, very strong, but I need something else. I need some confirmation, and that's a different type of strategy that I will pull in just to confirm that move.
Okay, so the next question would be harmonics. What are they? Can you explain that? I mean, I don't really know. I've heard of harmonics, but I'm sure there are lots of traders who have no
We
idea.
haven't got 18 hours to
Yeah,
try and
okay.
describe them. So, harmonic patterns basically when an instrument isn't trending. So a harmonic pattern is like two triangles together. Imagine a butterfly's wings, if you like, where we have an origin, which we call the A pivot, and then the price can move up, yeah, and then the B pivot forms, okay, and then we move. So we have an origin, sorry, an A, a B, a C, and then a D. So it's like a complex wave pattern. But with harmonics, the way these pivots are measured are with Fibonacci extensions, retracements, and then even overlaps. Okay, so if you put, those that listen to this on a chart, if you understand Fibonacci, that's the start for harmonics, because you will have those extensions to see if the A pivot forms at this particular point, and then it retraces to this point, and then the C pivot goes to an extension to that point. You can say that if the D pivot gets within this overlap of extensions, it's very complicated, honestly. That's where the D pivot should complete. Yeah. If it falls out of that zone, then the pattern is invalid in my instance. Now, it takes a lot of experience to be able to put these on your chart, recognize the patterns are forming, and then understand where the pivot should complete. They're very, very strong patterns, and there's butterfly, there's bat, there's crab, there's outbat, there's lists. It's so difficult, but guess what? We developed the software with all the rules, and it puts it all on the chart for you. It even tells you where the projected completion zone should be before it's even there. So if it completes in that zone, and it's coloured in green, you go for a long. But then if it completes in the completion zone and it's coloured in red, you go short. That's the power of technology. And this is really what sort of drove me to write the book, because trading should be simple. And if you've got the technology to make it simple, you can concentrate on other things. So, why spend 6 months to learn harmonics and get it wrong when you can program an algorithm to spot the different patterns, tell them where they should complete, and give traders rules to trade it? So if it completes in the completion zone, it's coloured in green, you're looking for a long. Yeah. Once it starts to move away to the upside again, for me, I always like confirmation. I'll look for an expert algo or a VWAP predator or a roller coaster or something just to give me that confidence in that flow. So my only advice to people on harmonics is, unless you have got an engineering background where you can understand fib extensions, fib retracements, understand the overlaps. I can spill off a load of bloody figures right now that will mean nothing to most people. Just let technology do the work. Once you get a signal, have you got the confirmation? Have you got fresh air to trade into? They're the three questions you should be saying. Let the technology give you the signal. We've got technology that's automated support and resistance zones. Let them put them on the chart. Have you got confirmation? Go. If not, if you've got confirmation but you've got no fresh air, follow the rules. Don't trade.
I like this phrase, fresh air. I think for people not familiar with what you're talking about, it's basically wide open space, isn't it? Either to the downside or the upside, right? Am I getting it right?
Correct.
Yeah.
Imagine an apartment block with no furniture in, just the floors. Yeah. So if you can imagine something's got so much force, it breaks through the ceiling of the apartment that you're in. It's broken resistance. There's a lot of fresh air to the next ceiling. It'll probably lose a little bit of momentum, come down, bounce off the floor, find support, get a signal, and you've got a lot of fresh air to the next ceiling. That's all it is. Or if it breaks down through the floor, there's a lot of fresh air to the next floor. That's all it is. You just need the skill set to be able to put those support and resistance zones on the chart.
Yeah. How many software packages, if you like, are you running at the same time? Like 2 or 3 at least? And how do you know which one to pick? What do you do when you get kind of 2 saying yes to 2 saying no? So you just
So if you've got contra confluences, that's the reason not to take the trade. So most retail traders look for reasons to get in a trade. That is totally the wrong mindset. All the stars need to be aligned. If you've got a contra confluence somewhere, you just don't trade. Yeah. So my setup is the same here as in Spain. Exactly. I've even got the same desk from IKEA. So I've got Five 27-inch monitors on my desk, and on my right hand side on the wall, I've got a 55-inch monitor vertically. But when you put the chart sets on there, it's like having three monitors. And this is all just for oil and copper. So on one screen, I'll have, on my main screen in front of me, oil, for example, I'll have three charts. One with my range breakout, because that defines the range for both the London and the oil pit open, so that I understand where those opening ranges are and I can trade in between them or breaking out of them. I'll have my roller coaster on top of that, which is for if we get range bound to go up, within the range. And then I have my slingshot on the left, which looks for those pullbacks when we're trending and slingshot forward. And then on the other screen for oil, I have the VWAP Predator, because that's a volume bias strategy, and I always use that for confirmation. And I also have the XBRAD algo as well. So if I get an XBRAD algo, the next candle I get a VWAP Predator, I'm saying, right, this is long here. The three strategies that I'm trading long, I need a long signal on there. And then I also, on all of the charts, have something called a bias depth heat map. So this heat map we developed, it looks up 6 timeframes from what you're on. Okay, so if you get a long signal and the bias depth heat map is red and yellow, you ain't going to go long because you haven't got confirmation on a higher time frame. So imagine trading as a train leaving the station. Institutional traders give the steam train, momentum to start those wheels running. Okay. And once it starts to move and it's moving along the platform, on the different time frames, if we're going long, for example, we'll start to have bullish biases on those time frames. Retail traders, the best thing to do is get on just before it leaves the platform and get on 2 stops before the end of the line. Just let the institutions make the decisions, understand that behavior, wait for the bias to give you that confirmation on the signals and go. So it's signal, confirmation from the bias depth heat map, fresh air.
Do you find your software works better at certain times of the day? I mean, does it respond better to data coming from, say, the morning session in the UK or Europe, or an American session, or whichever?
Absolutely. So we have automated strategy builders that help us understand the best times of the day to trade and the best days of week for specific instruments on specific time frames. So when we talk about the slingshot, the range breakout, the roller coaster, and the XBRAD algo on NinjaTrader, we can automate those strategies. But the main power of that software is not to get the executions and to manage the trade fall is fantastic. And I did one live yesterday on copper. It made $800. But the power becomes from the historical data and the back testing. So what it does, you can identify the slots of time each day that are good to trade and are profitable. You can find the time slots of the day which are not profitable. So when we're looking on a 10-minute time frame for range breakout, we look back 30 days and we have a rolling 30-day look back period, and we keep checking the data. There's a lot of data in there, and it's for sophisticated traders. But the idea is, for example, the range breakout on oil in January made just under $20,000 trading 3 contracts. It only traded 22 times in 30 days because it traded on the optimized times that we used the software for. So as long as that data doesn't change, we don't re-optimize. If we get a massive reset on data, so NFP comes out on a Friday and there's a massive miss and dollar goes all over the place and the data resets and behavior resets, we then run it for a week on sim. We re-optimize and then we put it live again. Imagine yourself as a pilot as a trader. You don't get put in the pilot seat flying an Airbus A380 straight away. You learn, you simulate, you fly. And then all of a sudden you go and fly, and these guys I play golf with today fly 747s for the royal family in Dubai. So all of a sudden you've been flying new technology, you can't sit straight into the cockpit of a 747 and fly it. You need to go through the simulator first. And that's the same with optimizing your strategies. Is if you get a massive reset on data, and you'll see that you'll get a massive gap on gold when it reacts to that data, and that's the sign that behavior's changed. Unless it retraces straight back and we carry on, which doesn't happen very often, there's a reset in behavior. So that's then the time to learn for a week and simulate to make sure you understand the new behavior. And that's what we do with those automated trading strategies. If you're trading on a scalping strategy like a Unirenko 135, we only look back 6 days. And sometimes we check that data every day. If we've only had a maximum consecutive losers of 2 and it goes to 3 on one day, we stop the strategy. We re-optimize, simulate, and go again. Traders think they have to trade every day and make money every day. Yeah. I trade 3 times a week for 90 minutes a day because I know the right times a day. Yeah. If so, I played golf today, for example. I'm interviewing with you. When I finish with you, I will be trading the pre-market US. It's a Thursday. There's data coming out. It's going to be fantastic. Yeah. So I know that's the time slot for me. I know it's a good time slot for oil on the slingshot. I've got the oil pit open at 9 a.m. Should be some good trades there. And copper will be trading on the gold pit open as well, because experience and optimization tells me that's the right time to trade. You don't need to sit in front of a computer 10 hours a day because it goes flat.
Yeah, and I think you sort of start to lose the plot the longer you stay in front of a screen, and you start trading almost anything that moves. That is a real risk, myself included. It's just I think
Yeah,
a lot of traders do that. They, especially if they're doing quite well, they think, right, this can carry on. I'm going in for another one. Going to beat my
you'll dig a
performance.
big hole.
Yeah, that's the risk, isn't it?
Yeah,
Yeah,
yeah.
I think just
I always say, so I have an apprenticeship and it's not cheap, but what I say to people here, and I've got one guy that started at the beginning of 2023, finished September 2023. He's a German guy, amazing. Vorsprung technique. He can follow rules. Yeah. And that's the thing. Okay. So we set a target for his first 6 months live trading to make $5,000 a week. So if he makes $5,000 by Wednesday morning, he stops trading. And people say, well, he could have made more, but he could have lost more. You haven't got a crystal ball. You can't look right. Build the confidence on those targets. Build up the account so then you can increase, if you're a European trader, lot size. But when you're talking futures, you're calling contracts. So start with one contract or two, depending on your account size. Get into the groove. Get into recognizing massive reset in data. The behavior's changed. Right, I've got to spend 2, 3, 4, 5 days now re-optimize understanding that data before I start live trading again. So I haven't traded that week. That's fine. My target wasn't hit. My target next week. I say 5,000, but if you're in a big trade and it goes and you make $7,000, obviously you're not going to get out the trade because you hit $5,000. You're gonna have your trading stop in there. So yesterday I had a target for this particular trade on copper of $600. In the end, it made $800. Because I trade when I trade live, I trade small stock. I only trade 3 contracts of copper because it's realistic for normal retail traders. When I trade privately, it's a different matter. But so with those 3 contracts, $500 to $600 per day is the target when I trade live. I had 3 trades, one winner, one break even, which neutralized each other, and then this last trade made $800. I didn't stop it at the $500 or $600. I just trailed the stop as per what I'm teaching. And as it was approaching that ceiling in the apartment, and it was a confluence of both 30 and 60-minute resistance zones, I just flattened the trade. I wasn't going to give it any more room to breathe because we had no more fresh air. And that was my day over. I didn't look for another trade because I when you're trading, you've got to be emotionless. Winning or losing, it doesn't matter. It's all mind over matter. I don't mind, the markets don't matter. And that's the philosophy you should have. If you have $100 day, you have $100 day. The next day, you could make $5,000. You don't know what's going to be around the corner. So on the oil range breakout, 22 trades in 31 days, yeah, for January. Some of them were only two, three, $500. One was $5,900 on one trade. You haven't got a crystal ball, but if you set your strategy up to look for those runners while still reducing the risk as you go along, you will get a runner. The gods of the markets, the confluences it might be once every 6 days. Usually for me, it's once every 30 days I get a good runner on oil. You just got to follow the same rules all the time. Get that muscle memory, and you will succeed.
We've mentioned data a few times in this chat. Where do you go for data on, just say, narrowing it down to copper and oil? What are the key things to look out for a trader?
So I'm looking at things that will move the US dollar. So I'm British here, but British data doesn't really affect the US dollar. Okay, European data does. What drives Europe? Germany. Yeah, so I'm looking at German inflation data. Usually on the same day, you get European inflation data coming out again, your CPI data, that sort of thing. And then US data, mainly sort of Thursdays and Fridays, you get those NFP, CPI, inflation data can be a little bit sort of mute at the moment. But what you're looking for is things that move the US dollar. If you're trading gold, if you're trading 6E, which is euro US dollar, everything will react to the US dollar. That is the nucleus. Yeah. Whether we like it or not, the US dollar is the nucleus of everything that goes off in this world. Yeah. Okay. It's not Trump, it's not Biden, it's none of that political crap. Everything, whether it's oil, whether it's gold, everything, US dollar. Okay. As soon as you can accept that and understand how other instruments react to that movement in the US dollar, you've got over the first hurdle. You then need to understand those data points. And a good trading view on, for example, is free. If you get the free version, you get an economic calendar on TradingView. And you can see what those are. And they'll even tell you with a little red dot or a little orange dot, or if it's a yellow dot, not really going to do anything. Orange dot, could do something. If it's a red dot, you need to be aware of it. That, setting up the operational landscapes, not just drawing stuff on a chart, it's actually understanding what's going to happen each day of the week that you're going to trade. So for me, first thing on a Monday morning, I've been doing it that long, I know what's happening, but always check what data's coming out at what time. That is going to dictate whether your specific times of the day are going to be dangerous or good. For Fed day, usually I don't even trade, but that's the only slot I had to trade yesterday. So I had to trade pre-market, use that German data to react with the US dollar to give me a trade. But as soon as the US market opens, it doesn't go flat, it goes volatile. There's no real direction until Fed starts to speak. And then sometimes there's a reaction in either direction. But mostly Fed days, I don't trade at all.
Yeah, it feels very much like a gamble, doesn't it?
It is, because what you've got to think of is even though there's 95 million retail traders in the world, they don't move markets. Okay. So one money manager, for me, for example, I would trade 30 to 50 contracts on oil or copper. That doesn't move markets. But when you get, so that's an institutional trader, but when you get 100 or 150 institutional traders, all seeing that confluence of support that copper's just about to hit, guess what? They're all going to put buy orders on down there. They're the ones that move the market, that move the train away from that support, from that station. Retail traders don't do that, but what they can do is recognize that support, recognize the potential of what's going to happen, make sure there's no data, or make sure there is data, wait for it to happen, see if that's the catalyst for that to catapult those institutional traders with those 50, 100 contract type trades, then get in.
How do you react generally to those big spikes that you typically get at, say, 1:30 UK time? You'll get some data come in, and it goes up, and then it goes down, and we're doing this like on a needle. Will
Yeah,
you just sort
so
of stay out at that point, or?
I have a strategy. I look for reversals on data, but you can only use an automated strategy for that because the movements are so quick and you've got to get in within sort of like zero point 0.2 milliseconds or something. So our software does that on NinjaTrader. It's pretty cool. But for the normal person, you would wait for 15 minutes and see which direction the market has chosen. A lot of the time, you can imagine, we'll go back to the apartment scenario where you've got a floor and a ceiling. So what will happen is if you're in the middle of that room, for example, and you've got data coming out, an institutional trader would recognize, because he has the software, to look at the confluence where those multi-time frame supports are and where those resistances are. So what will happen is when that data comes out, the algorithms that institutions have got will react to the data. But say it sends it down, what will happen is there'll be a crap ton of buy orders down at that support from institutional traders that you won't know about. So you'll think, oh, everything's going down, I'm going to go short. No, they've got all those buy orders there waiting for all the mugs and all the retail traders to see it's going down, press sell. All those contracts are open, and guess what? They'll get filled by those institutional traders that support. And guess what? It goes up massively. And guess what they've got at the ceiling? Sell orders. Yeah. And this can all happen in 5 to 10 minutes. So they say they all put 100 contracts on to buy at that support. There's been enough volume of buy contracts and all those losers from the retail traders, the momentum has changed and it's gone up. But guess what? They don't need to be in for long. They know where that resistance is. They put all their sell orders there. And that's where you get that volatility from the institutional traders recognizing where that is and putting those orders on. The best thing to do, wait for 15 minutes and see which way the market, the directional flow is going. Unless you've got software like ours where we actually look at the 10-minute interval before data comes out, and we call it a reversal on the range. So, and we only trade on that 8:30 data, AM EST, yeah, which is your whatever time in the UK. I haven't lived in the UK for 20 years, so all my computers are on EST time as well. So what we do is look at the 8:20 to 8:30 candle, and we define that range. We also define the bias for that range. So if gold is moving up, for example, and that first 10-minute candle get the range and the bias is green, I have the reversal on. But when the data comes out that second after, I know the algorithms from the institutions will have that initial reaction. I'm only interested in the reversal because that reaction is more powerful than the continuation. So I will wait. I might get 6 to 10 ticks slippage, but I've got my profit down at 100 ticks and it hits it with, I can tell you now, sometimes 13 seconds the trade's in. Okay. And because I'm waiting for the train to get away from the station. The algorithms will push it in a certain direction. I'm only interested in reversals. I know I need to get off before the next support level because I know that's where all the orders are. So I will just take the 100 ticks, get out, take the money. I'll then, that'll probably 2 contracts, and then I'll put 1 or 2 contracts on at that support for the return leg. And that's how I trade data. For most retail traders, wait for 15 minutes. I always say if you want to trade NASDAQ or ES, wait for the first 15 minutes after the market's open. Usually by that time, that first initial, that opening range has been defined. Once it starts to break out to the upside or the downside, that's generally where the direction is, unless we've got data coming out later in the day.
What qualities would you identify in yourself that have made you such a good trader, so successfully consistent as well?
I think it's the ability to learn, simulate, then trade, and have the ability to stick to rules. So I was in the military for 15 years. You don't stay in the military for 15 years by breaking the rules. It's just as simple as that. So this is where that signal confirmation fresh air comes from. If I get a signal and I've got fresh air but I've got no confirmation, I won't trade. It's just black and white, and this is why all our branding is my face in 2D, but half of it's robot, because there's no looking for reason. Oh, this looks good, I might just trade that anyway. There's literally a set of rules, and I can follow rules blindly, and that's what you do as a soldier. If somebody tells you to go that way, you go that way. You don't question the rules because you've been told to do that. And if you've got three specific rules for trading, you're letting the software do the rest of the work. Just stick to those three rules, and that's what it's all about. And it's difficult when you first start, and I did go through this. So money is always a key driver for traders. So if you're getting into trading to make loads of money because you haven't got loads of money, that's the wrong reason to get into trading. Yeah.
Absolutely.
The reason to get into trading, and again, I've got a pilot starting on our apprenticeship in April. He isn't desperate to make the money. He's desperate to change his life, to not be away from his family and his wife to bid for flights and things like that. So he has the time to learn, to simulate, to practice, then trade. Yeah. Because if you just try and get into it straight away with the desperation to make money, you will never succeed. If you get into it like I did as a hobby, I think they call it I can't remember what they call it now, a second income or whatever it is,
Side hustle.
uh, yeah, side hustle
Yeah.
or whatever. Just trade on sim, learn, get the software to take a lot of the heavy lifting off you, learn the rules, simulate, and then start trading. My it's a 40-week apprentice that we run. They're not allowed to trade live for 40 weeks. They're not allowed. I'll throw them out if they do, because they need to simulate. They need to then send me the trades, and we need to discuss why they went wrong or why they went right. That's the only way to build that muscle memory for when you do it with real money, because then you've also built that mind over matter thing. Okay. If you consistently on your simulation hitting your target every week, and you're following the same rules, and you're understanding when economic data comes out, you keep an eye on the main news for major geopolitical events and all that sort of thing, and Mr. Trump can becoming president. There's lots of things going on. Once you get into that muscle memory state, trading becomes a lot easier. If you try and get into that state with real money straight away, it just won't work, because you'll dig a hole, and guess what? The hole will get bigger, and then the hole will get bigger, and then you'll look for another reason to trade. Oh yeah, and the hole will get bigger. You'll never fill the hole. When you have simulated, you will always get losses on simulators, but then you will learn your only priority is to fill that hole slowly. Because imagine a big excavator could dig a hole quite quickly. If you're filling it in by hand, it takes a little bit longer. Okay. So one bucket of an excavator would take 5 minutes, less than that to actually dig the hole. And that's how quickly you can lose money in the markets. To fill that hole back up again, just imagine yourself having a shovel, and it takes you a couple of hours. Yeah. And that's your priority for the rest of the day or for the following day. If you've had a loss and nothing is setting up within the next 30 minutes to 60 minutes, walk away. Your strategy for the next day is to fill the hole from the previous day. Once it's filled, stop trading. You're back to level again. Yeah. And then go back to muscle memory, start to do the trade. Look at the signals. Where's the support and resistance? Have I got fresh air? Have I got the confirmation? Just and that's the way to do it. I have losing days, you know. And if it's a big losing day, I will say to myself, right, I'm going smaller contracts now. I'm going to take 2 or 3 days to fill this hole, and that's what I've always done because there's no 100%. I'd be a billionaire right now if there was a 100% win rate. Absolutely. I mean, you can run a strategy that has 85% win rate, but the drawdowns on your losses could be quite large, even with an 85% win rate. Over the years, I've learned actually my fresh air has to be a minimum of 1 to 1.6. So if my risk is $100, I'm going to wring $160 of fresh air. Yeah. 85% of the time, it will reach that $160. Yeah. 15% of the time, it will take the $100 away from me. So my fresh air has to be a minimum amount as well. That reduces those massive drawdowns on those losers that you get.
We've talked about your various software kits. Which would you recommend to start off with for a trader who's been trading a year, maybe 2 years, hasn't used software of this kind of caliber before? Where would you start?
The range breakout is the obvious starting point for me because it really just defines your trading day. So I'm going to go for oil, for example. The range looks at the first 10-minute candle of oil at the London opening range. You can set that, okay, and you can trade when it breaks out up and down. So that will define a certain time of the day, because the biggest power is that opening range, and then when it breaks out. And then the oil pit open at 9 a.m. EST would be another range. That defines almost your operational landscape as well. Very simple to trade. But you also need what we call the bias depth heat map. I discussed it earlier, is for your confirmation. Yeah. So if you've got a range breakout signal, so if the opening range is colored in green, for example, you're only looking for a long breakout. If you've got all 6 timeframes green on the bottom, you've got your confirmation. As long as you've got fresh air, go. And that makes it simple. Plus, also, that is available on lots of platforms, whether it's MT4, NinjaTrader, TradingView, TradeStation, Motivate. So it's on a lot. And I think that's a good starting point to start to introduce technology because a lot of people do trade that range, but they've got to draw it on themselves. They've got to figure out, is the bias of the range neutral, bearish, or bullish? The software does that for you. So if you get an opening range, if you're a gold trader, the gold pit open is 8 a.m. In London, European time. London time. What you're looking for is to define that first 10 minutes because that's when gold traders start work. That's when there's more volume. And if you define that range, it's okay defining it, but you'll need to understand the bias of that range. So if the bias is yellow and it's neutral, we have a strategy called a straddle strategy. You put a short order on below the range, a long order above, and it will choose, the market will choose direction. And if the long goes in, your short becomes your stop. If the range is green, coloured in green, you're only going long. If it goes short out of there, there's going to be little momentum to probably come back through. If it's red, you only trade short. The bias depth heat map gives you the confirmation. So if you get a green range and you've got red and yellow on your bias, the momentum probably won't continue to go to the upside. So you just don't trade, and that's the rules. So that's what I would. But I would also suggest reading the book as well, because some traders just go and watch a load of YouTube videos and you think, yeah, I can do it. Yeah. But, I've read quite a few trading books in my time. Some of them have been very complex, very, blow my mind. I mean, I'm an ex-engineer. I've got quite a good mind, but some of them were literally trying to look too clever. Read the book, understand confluences, understand economic data, understand the flow of how you should be trading. Look at some of the strategies in there as well. because that will help you start to decide which instrument you're going to get married to. Because you've
Okay.
got to choose one instrument. Once you've chosen that one instrument, go to the range breakout, get the bias depth heat map. That's the start of your trading journey. And your trading then should become a business. Return on investment. Yeah. So the range breakout is $1,000 for life. Yeah. So what's your target to make the return on that investment? Okay. So 3 months for me. So first month, learn. Yeah. Watch the educational videos, learn how to use it. Second month, simulate. Third month, live trading when your simulations are going well. And that's the process. So don't try and make $1,000 on the first day. You know, my next book is going to be called The Problem with Retail Traders. And I actually have three categories for those traders. And this comes from 10 years of experience with 27,000 users of our software so far, all over the world, and talking to these people. I even, before COVID, I'd fly to New York and hang out with them and do a seminar and stuff. So you get what we call desperados, okay? You get entitled traders, but then you get the pilot traders, okay? So these two need to go and be pilot traders. So there are always reasons why the desperados start trading, and a lot of those will not follow the route as a pilot does. So you don't learn, they don't simulate and practice, they then go live. What they do is they spend their last $1,000 on a piece of software and think they need to make money straight away, and they don't learn. For example, your entitled traders spend $5,000 on lots of software and expect it to be the magic bullet and start to win straight away. In reality, you need to learn, simulate, and then trade, and that's the flow that we should have. So even once you if you get the book, or you go for the range breakout, don't expect to win money straight away. A pilot doesn't start flying you around the globe straight away. Uh, Even if he's done 4 years at college or university, he has to go through a lot of hours of simulation so he doesn't kill somebody. And the markets can be very dangerous. So you need to learn, simulate, and trade.
Hey, Paul, thanks so much. I'm going to put your links in the description notes for anyone watching. Good. Thanks for being with me.
Thank you very much. I enjoyed it.